Hello, this is Troy Stavros, broker and partner with the Holloway Group at Gables & Gates Realtors. Here to talk to you today about the top 3 things that lenders love. The first thing that lenders love is a top-notch credit history. The very first thing a lender will do is pull your credit and check your credit history. Now, you should know that while perfection isn't needed, the better your credit history, the better interest rate and conditions you will get from the bank. Lenders we spoke to said a credit score of 750 and above will get you the best rate. That a credit score of 720 and above will get you close to the best rate, if not the best rate, but the conditions may not be as good as if your credit score was 750 or above. And they also told us that a credit score of 640 or below 640 would find it difficult to get loan approval. The second thing that lenders love is a low loan-to-value or LTV ratio. Now, what is a loan-to-value ratio? A loan-to-value ratio is the ratio between the amount of money that you are borrowing and the appraised value of the home that you are purchasing. So say, for example, the home that you're buying is assessed or appraised at $350,000 and you are getting a loan for $300,000. What you would do is you would divide that $300,000 into $350,000, and that would give you a loan-to-value ratio of 86%. Now, you may have heard that lenders are looking to get 20% down as the down payment on a mortgage. Now, the reason for that is, one, most conventional loans ask for 20% down, and that's because banks like a loan-to-value ratio of 80% or better. So, that being said, save up for your down payment. The third thing that lenders love is stable income. What a lender will do is will look at a history of your income so they can see, one, how much money you are making on a monthly basis, and two, how long you've been working at that particular job. So let's say, for example, you have an average income over the last 2 to 3 years of $40,000 per year. They will take that number and they will divide that number by 12, giving them an average monthly income of $4,000. Once they have that number, they will use what is called a debt-to-income ratio. What the debt-to-income ratio tells them is what percentage of your monthly income is going towards, one, your housing expenses, and two, your overall recurring monthly debt. So, for example, on a conventional loan, most lenders are looking for a percentage of 28% of your monthly income, no more than 28% of your monthly income going towards housing expenses. And when I say housing expenses, those are, for example, your principal and interest payment for your mortgage payment, your property taxes, your homeowner's insurance, your homeowners association fees, and possibly mortgage interest payments. Then on your total recurring monthly debt, they want that to be no more than 36% of your monthly income. So, for example, your recurring debt might be things like credit card payments, student loan, car payments, or any other monthly recurring debt. To figure out what those ratios are, what they will do is they will take your monthly income, so for our example, $4,000, and they will multiply that by 28% to figure out how much money you can afford as far as housing expenses. So, for example, if they took $4,000 times 28%, that would equal $1,120 that you would be allowed to spend for housing expenses. Any number above that, you would not fall within the ratios and you would have trouble getting approved. That's step one. Then step two looks at total housing expenses. So for that, you would take your $4,000 and you would multiply that by 36%. Okay, so 4,000 times 36% equals $1,440 that you would have to spend on your total monthly recurring debt. Once again, if you are over that, you're going to have trouble getting approved. The key to a smooth real estate transaction is eliminating surprises. So now that you know what the top 3 things that lenders love are, that should help eliminate any surprises before you go to speak to a lender. So before you speak to a lender or even start looking at Knoxville homes, you should look at what these top 3 things are and make sure that you are squared away. So what have we learned from this lesson? Well, the top 3 things that you should have squared away before you speak with a lender or start looking at homes are: number 1, you should fix any issues with your credit. Pull a credit report, see if there's anything on there that looks negative, and fix it. Second thing you should do is save up for your down payment. A conventional loan is asking for 20% down. Are there others that you can get with less than 20%? Yes, but the better off you are with more money down, the better interest rate you'll get. And then the third thing you should do is reduce your debt. Those are the top 3 things that lenders love, and the top 3 things you should be doing before buying a home in Knoxville. Thanks for talking with me, and I'll talk to you soon. This is Troy Stavros with the Holloway Group at Gables & Gates Realtors.